All right, let's go ahead and get started. Good morning, everyone. I'm Amanda Gerber, Marketing Director with DWD. Thank you so much for your interest in our session today, maintaining tax-exempt status. For those of you that have questions during the presentation, please submit them using the Q&A feature. We will have our nonprofit services team's members, Tyson Moore and Susan Bergoff, available to answer questions that are submitted. With us today presenting is Carrie Minnick. She is the director of our nonprofit services team. At this time, I will turn it over to Carrie to get started.
Thanks, Amanda. So as Amanda said, today we're going to be talking about maintaining your tax-exempt status. Now, as a 501c3 organization or another tax-exempt organization, you receive a lot of benefits, such as you don't have to pay state income taxes, federal unemployment taxes, you may receive tax deductible contributions, even state sales tax and reduced postal rates. But along with these benefits comes certain responsibilities that you have to do. And that's what we're going to talk about today. Really the do's and the don'ts of being a tax-exempt organization. So first, we're going to talk about the don'ts. So these are things that we need to be aware of. Either we don't want to engage in them at all, or we want to limit our interaction and activity with these types of transactions. Private benefit and inurement, excessive compensation, political campaign intervention, extensive lobbying, and also excessive unrelated business income. Obviously, we're not going to go over every single item today that of things that you shouldn't do and should do. However, these are kind of the key top areas that we really want to make sure that we're following, to make sure that we maintain our tax-exempt status. So we also have some things that we're going to talk about that we really want to make sure that we do to maintain our tax-exempt status. Maintaining our exempt purpose, having an active and engaged board, record keeping, required annual filings, public disclosures. There are certain rules on charitable contribution substantiation, and also our public charity status. So as we get started, we're going to again start with the things that we shouldn't do, or we need to watch how much we engage in these activities. And the first is private benefit and inurement. So 501c3 organizations must not be organized or operated for the benefit of private interests. So that's just straight out the IRS says that. No part of your earnings may ensure to the benefit of any private shareholder or individual. So what does that mean? So what we're talking about here, private benefit, occurs when an insider who may be a board member or a trustee, an officer of the organization, someone in management, highest paid employees, maybe a founder or even a major donor, when they receive benefits from the nonprofit in excess of what they provide in return. So really when they're benefiting from a transaction because they have this relationship with the organization. And some examples are excessive compensation. So, paying more than what the individual should be paid, the sale or purchase of an asset to or from an insider, renting property to or from an insider, lending money to an insider, or using the organization's facilities to the use of the organization's facilities by an insider. So again, we're not saying that you can't sell or purchase an asset from an insider, or that you can't rent property from an insider. You just have to be careful in these transactions that the transaction is considered fair and reasonable under the circumstances. Again, we don't want those individuals, a board member or someone that's closely related to the organization, those insiders, to receive any kind of special treatment or any kind of benefit because they are related to the organization. If, however, a transaction happens and it is not considered fair and reasonable, and that the insider does receive some kind of benefit, the organization may lose its tax-exempt status. And obviously we don't want that to happen. And then that may result in intermediate sanctions. And this is where the insider, so that individual, that board member, that person in management, would be required to pay a tax equal to 25% of the excess benefit received. Also, that individual, the insider, is required to make the organization whole again within a specified period of time. Failure to do so may result in additional taxes. And then the organization, the board members of the organization who knowingly approve the transaction are also taxed, have to pay a 10% tax of the excess benefit. And there's also no de minimis amount for private benefit. So again, it's okay to have transactions with your board members, insiders, those types of things. You just want to make sure that obviously that everyone is aware of it, but also that there is that person is not receiving any type of benefit that a normal a person that's not related to the organization would receive. And obviously the IRS is pretty strict on this. It is a very important issue with the IRS because they do impose all of these different types of taxes.
Carrie, we have a question.
Yes.
A clarification as to what make the organization whole.
So for example, let's say that because of this transaction, the organization lost $10,000 of investments. So for let's just say there's some kind of transaction and the organization, as a result, the investments went down $10,000. So in order to make the organization whole again, the insider would need to put $10,000 back into the investments plus any gains on those investments that they would have lost during that time period. So we need to put the organization back to where they were before. Or for example, if there was a transaction where a nonprofit paid rent to a related party and the rent was excessive. Let's say it was $10,000 and it should have only been $5,000. Well, in order to make that organization whole again, the insider is going to have to pay back that $10,000 to get them back to where they were before. So like the transaction didn't happen. And obviously that's going to depend on what kind of transaction it is. But the key is, so the nonprofit organization doesn't have any losses, is not in a negative position because of this transaction that happened that shouldn't have happened. All right, so one of the most common types of private interment, private benefit situation is excessive compensation. So first of all, excessive compensation includes all kinds of compensation. It's your regular salary, it's your bonuses, it's fringe benefits, it's the retirement and insurance that the nonprofit is paying on behalf of this individual. And we're talking about like primarily the CEO or the executive director. So, and again, this normally isn't a huge issue in the Fort Wayne area. However, it is a big issue with the IRS, and the compensation of executive directors and CEOs of nonprofits is a really big area that the IRS looks at, which is one reason why there's so many questions on the 990 about compensation. So in order for compensation to be presumed to be reasonable, the compensation of the key employees, the ED, the CEOs, need to be approved in advance by a group of individuals with no conflict of interest. So, normally you'll have your executive committee or maybe an HR committee. So they need to approve the compensation in advance. The compensation amount should also include comparable data, which means we need to look at other nonprofit organizations that are similar to ours to see how much they are paying their ED. And then also we need to document it. So obviously when you're looking at comparable data, you're going to want to look at organizations that provide similar types of services, that are the similar size, maybe have been around as far as an existence for the same amount of time, and also geography, because obviously the salaries out in California are not going to be comparable to Indiana. So that's something to keep in mind as well. When you're looking for comparable data, there is a Northeast Indiana salary survey for nonprofits that's issued every so often by a couple, I think it's maybe the United Way, the Community Foundation, and another nonprofit organization out of Indianapolis. Every so often puts together a salary guide, which puts together various benefits and salaries for nonprofit organizations, actual information that they've received from nonprofits in our area. So if that is something that you're not aware of or that you would like access to, you can just let us know and we can send you a link to that. You can also look on the IRS website or GuideStar to look up other nonprofit 990s. If the 990 is completed properly, it will show the executive director's salary for various nonprofits as well. And one thing to keep in mind too is that the salary and compensation for one organization may not be reasonable for another. So let's say organization A has an executive director that has many years of experience. Maybe they have a master's or a PhD or some kind of additional education. So it might be reasonable to pay them $100,000. However, organization B is a brand new executive director. That organization is much smaller. So paying that executive director $100,000 probably is not reasonable. So just make sure that the amount that you're paying your ED or your CEO is reasonable for your organization. Document it and make sure that it is approved, because there are questions on the 990 as well that asks how your compensation for EDs and ED/CEO and key employees is determined. So you want to be able to answer that appropriately. Next is political campaign intervention. So we, as a 501c3 organization, we are absolutely prohibited from participating in any political campaign activity. So that is just straight out no. We can't do it in any type, any fashion, any amount. It's just, you cannot do it. So what is political activity? That is an activity that supports or opposes a candidate for elective federal, state, or local public office. So a candidate is anyone who offers themselves up for public office or is proposed by others for public office. And it doesn't matter whether the candidate is elected or defeated. It's just if that person is running for an office, we can't in any means say that we are for or against that. And some specific examples, again, are endorsing candidates, contributing to the candidates or their PACs, their political action committees, public statements for or against a particular candidate, and then also distributing materials that favor or oppose a candidate. And that would be, the materials would be both those prepared by the organization or by others that favor or oppose a candidate. Again, if you do have political campaign activity, depending on what your organization is doing and how much, it could result in a loss of tax-exempt status, which again is not good. We don't want that. You may also be taxed on the amount of money spent on the political campaign activity. Again, management, the board may also have some of those penalties. So we really need to make sure that we're educating everyone within the organization, including our board and staff, on what we can and cannot say. So obviously, individuals related to an organization, your board members, your employees, they are free to make personal political statements. I mean, that's freedom of speech. They can say what they want, but you just need to make it very clear that when they're making these statements, that it is their own personal opinion, not the view of the organization. Some organizations also have a written policy on political campaign involvement that says, what it is and that they're not going to be involved in that. So if that is something that you'd be interested in obtaining, we have a copy of that we would be happy to give to you as well.
Hey, Karen?
Yes.
Real quick, could you rename the organization that publishes the salary guide? Can you say that again?
Yeah, it's the Northeast Indiana nonprofit salary guide. And I think the last one that they did was in 2019. It's out on the internet. And I believe it's 3 different organizations that put it together. And I believe it's the Community Foundation of Greater Fort Wayne, United Way, and there's another nonprofit, maybe Charitable Advisors out of Indianapolis that puts it together. But I can easily access that to the attendees, and we can get that out to them if they would be interested in obtaining that.
Oh, thank
So next is lobbying. So lobbying is a little bit different than political activity. And again, another difference is that 501c3 organizations can engage in some lobbying, unlike the political activity. Remember, we can't do anything with political activity, but we can do some lobbying so long as that it is not substantial activity. So what is lobbying? What's the difference between lobbying and political activity? Lobbying are activities intended to influence legislation, whether it be foreign, national, state, or local legislation. So these activities may include direct lobbying, attempting to influence legislators, or grassroots lobbying, attempting to influence legislation by influencing the general public. So again, it's okay if a 501c3 organization does participate in some lobbying. However, if it's a substantial part of your activities, then the organization may lose its tax exempt status. If you are an organization that maybe does do lobbying and it's not just a little bit, but you're not sure if it is substantial, you could complete a 501h election by filing Form 5768 to determine how much of your total expenditures could be spent on lobbying to make sure that you are under that substantial amount. You don't need to, but if you are worried that you're getting to that substantial level, you could complete that just to kind of as a protection. And then we also have advocacy. So we have political advocacy, political activity, which we cannot do as a 501c3. We have lobbying, which we can do a little bit, but we can't have extensive lobbying. But then we have advocacy. So advocacy is the process of making your voices heard on issues that affect the lives of your constituents, of your clients, of your members. It also means helping policymakers find specific solutions to persistent problems. So 501c3 organizations can advocate, and they should advocate for their mission. Unlike the political activity and lobbying, advocacy is about education. Educating your city leaders about the effects of a policy on your constituency, or maybe inviting your congressman to visit your organization to see how funding affects the daily operations. So unlike lobbying, that's a call to action in favor or against legislation, or even the political activity where you're in favor or against a person running for office. Advocacy is about educating policymakers about the needs of your organization and how the policies affect your organization. So advocacy certainly is something that your organization can and should participate in. The next item that we need to be careful about is unrelated business income. So as a 501c3 or a tax-exempt organization, you are eligible for tax exemption. So you do not have to pay taxes on your income. That's a benefit. However, for-profit corporations, they obviously are taxed 21% for federal and 5.25% for Indiana for 2021. So in order to make it fair between a nonprofit and a for-profit that are getting income from the same purpose, the IRS has unrelated business income. So unrelated business income results from a trade or business that is regularly carried on and is not substantially related to furthering the exempt purpose of the organization. So all three of these items must be met. It does not matter what the income is used for. It does not matter that you're putting all the income back into your organization or that you're giving it away as grants. It does not matter. The IRS considers, it looks at where the income is coming from. So what activity produced this income? There are some specific exclusions to unrelated business income. If the activity is mostly done by volunteers, if it is for the convenience of members or patients, for example, like a cafeteria in a hospital or a school may be considered not unrelated business income because the sale of that food is for the convenience of the patients or the students or the members. Sale of donated merchandise is not considered unrelated business income. Bingo is specifically excluded. Interest income, dividends, interest, gains and losses, those are all specifically excluded from unrelated business income. And also the rental of real property is specifically excluded from unrelated business income. However, if you do have a mortgage on real property on a building and you are renting that, then that rent income is considered unrelated business income. A portion of it is. Another common example of unrelated business income is advertising. The sale of advertising spots in a brochure or a magazine or at your business location. If it looks like advertising, if it's called advertising, then that's advertising. The IRS considers it advertising versus a sponsorship. So again, it's okay to have some unrelated business income. However, we don't want to have an excessive amount because really then we're not following what our exempt purpose is for. If you do have unrelated business income, then you have to pay unrelated business income taxes on that net income. So we take our total unrelated business income and we reduce it by any expenses that are related to that income. There's also a $1,000 standard amount deduction that we take out. And then that net amount is taxed both at the federal and state level at that corporate level. So again, it's okay to have some unrelated business income. However, we want to limit the amount that we have. And just like the excessive compensation, what is okay for one organization may not be okay for another one. Same with unrelated business income. What is considered unrelated for one organization may not be considered unrelated for another organization. For example, many churches have coffee and they may sell the coffee. Well, on Sundays, before or after the service. Well, technically that sale of coffee is considered unrelated business income because it is not related to the church's purpose, what their exempt purpose is. However, let's say we have another nonprofit and their purpose is to help people that may have a handicap get back into working. And so as part of their programming, they have a coffee shop where their clients, their members of their organization that they're helping, they work at because it's more difficult for them to get a job somewhere else. So they have this coffee shop that the nonprofit runs where these individuals that may be limited as to where they can get a job somewhere else because of a certain handicap, they are working in this coffee shop. So because this coffee shop is directly related to their exempt purpose in helping those individuals, it's not considered unrelated business income. So something to keep in mind, unrelated business income is a very gray area. So as you look over your income sources, just making sure that if you see any new ones, whether that is unrelated business or not. So moving on to, we've covered all of the things that we shouldn't do or that we really need to watch on how much we engage in. So now here are some things that we need to make sure that we are doing. And the first is our exempt purpose. So to be exempt under 501c3, an organization must be organized and operated exclusively for the exempt purposes listed in the IRS code, which is, charitable, religious, educational, and so on. If your organization ceases to be operated exclusively for these purposes, then it may lose its tax exempt purpose. So obviously when you applied with the IRS to be tax exempt, you told them what your exempt purpose was going to be, whether it be providing education, whether it be, whatever kind of services that you were going to provide. They said, okay, yes, this meets our requirements. You are a nonprofit organization. So if you fail to continue to be existence for that purpose, or if you change your purposes, that may lead to mission drift and the possibility of your organization losing its tax exempt status. So that's why it's very important on your 990 each year that if you do have significant changes to your programming, that you notify the IRS what those changes are. There is a question on the 990 that says, has the organization made any significant changes to its programs during the year? And that's why it's asking that question. They want to know what kind of changes you've made from your original purpose that you told them that you were going to do. And it's important for you to tell them what those changes are, so that way they don't come back later on if you haven't told them, and then you perhaps get audited by the IRS or some other question comes up and they start looking at what you're doing and they say, okay, well, what is this service income that you're getting? You never told us about this. This is not part of your exempt purpose. This is unrelated to your exempt purpose. This is going to be taxed as unrelated business income, or it's just not completely unrelated to a nonprofit, and you're going to lose your tax exemption altogether. So again, significant changes to programs. Maybe you provide reading services to adults and then you changed it and now you provide reading services to adults and children. That's probably not a significant change. But something else that is totally different than what you've been doing, you want to notify the IRS what those changes are. The next thing that we need to make sure that we have is an active and engaged board. So obviously in the state of Indiana, all nonprofits have to have a board of directors. It's required that there are 3 members on the board. The IRS also believes that a well-governed charity is more likely to obey the tax laws, safeguard the assets of the organization, and serve charitable interests than one that has poor governance. The IRS encourages an active and engaged board. That way it can ensure that there's oversight over the nonprofit and that it is compliance with applicable tax law requirements. In addition to being active and engaged, your board should be composed of persons who are informed of the operations and finances. We want to make sure that they know what's going on. Also, we want to make sure that they are individuals that are needed by the organization. So for example, do you have an accountant or a lawyer? Do you need somebody with marketing skills? Do you need, someone with education, maybe a teacher because you provide education services. So looking to see, who is on your board and do you have the right people on your board? Also, we want to make sure that we look at the size of the board, making sure that it is large enough to have independence, because we want to make sure that there are independent board members, but also if it's too large, it's going to be more difficult to get business done and make decisions. But too small of boards, then the board members become overwhelmed. It's not representing a sufficiently broad public interest. So making sure that your organization's board is the correct size. And there are lots of questions on the annual 990 that ask about your board, both the composition of the board and, if the board members are independent. So the IRS is very interested in who is serving on your board, and what kind of activities your board does. Does it review the 990, that type of thing? So again, just making sure that your board is active and engaged. Next is record keeping. So as a nonprofit organization, not only do you have to file a 990, but you may have to have an audit or review done. Obviously, you're going to issue monthly financial statements. So in order to do all this, we need to make sure that we have good records to produce these reports. There are certain documents that we need to make sure that we maintain. Your organizing documents, especially your tax exempt form 1023, your EIN, your articles of incorporation, your bylaws, making sure that we have a copy of all of those. And these records should really be maintained at the organization's office. I know sometimes I've come across organizations where maybe some records are kept at a board member's or an ED's house. We really want all of these documents to be maintained at the organization's office. Minutes, when we have board meetings, finance committee meetings, executive committee meetings, we want to make sure we're taking written minutes. That's actually required by state law, those board minutes. We want to make sure that we maintain those. Employment records. So if you have employees, we want to make sure that we have documents that show salaries, wages, benefits, taxes withheld, personnel files that include written job descriptions, background checks, any type of withholding documents like the IRS Form W-4 or WH-4 for the state of Indiana, those types of documents. Form I-9 to make sure that they're able to work in the United States. And these employment records, the IRS recommends that you keep those at least 4 years. And then we also have financial records. So our records that support our income, expenses, and assets. So for income, that's going to be your money coming in. So your receipt books, check copies, grant letters, deposit slips, bank statements, especially documentation on any restricted funds. If you get money from donors that say the money needs to be spent on for a specific purpose or for a specific time period, we really want to make sure that we maintain some type of document that shows what that restriction is to make sure that we are following that restriction. The IRS suggests documents related to income be kept for 3 years after the date of the 990. But we'll talk about years, how long to keep in a little bit, but the IRS recommends 3, so 3 years is probably your minimum. And then expenses on the other side, money going out. So documentation supporting what the organization has spent its funds on, canceled checks, invoices, credit card statements, account statements, agreements, anything supporting who you paid, why it was paid, the dollar amount that was paid, and the date that it was paid. And then finally, assets. These show the items that your organization owns and uses in its activities. This is going to be both like investments, but then also, buildings, furniture, that type of thing. The records related to your assets are going to show when and how the asset was acquired, whether any debt was used to acquire it. So if you have any mortgages or loans, you want to make sure you keep those agreements. Cost of improvements. If you dispose of any kind of assets, documentation on when and how it was disposed of, if you sold it, what kind of proceeds you received, or if you just, trashed it. And then also just any kind of closing statements, agreements, financial account statements, those types of things. The IRS doesn't require a specific record keeping system. However, if your organization has more than one program, your record keeping system really should allow you to track the income and expenses for each program separately. And really what you're looking for is a summary of transactions. So obviously most people will use some kind of accounting software such as QuickBooks, but really that's not a requirement. Obviously it's best practices to have some kind of accounting system. So as opposed to having it in Excel or on paper, just because of the additional reports that it can provide, and the reduction in errors that it may have on an Excel spreadsheet or a paper report. But there is no actual specific required record keeping system that the IRS has. So, we talked a little bit about keeping documents, payroll documents for 4 years, the other items for 3 years. The Sarbanes-Oxley Act of 2002 came out, and it was mostly applicable to for-profit entities. However, there are 2 policies in this act that are required for nonprofits to implement, and one of those is the document retention and destruction policy. So this is a written policy that all nonprofits should have in place, and it describes how, where, and for how long the organization's documents are kept, as well as how and when they are destroyed. So all of those different documents, like your bylaws, your 1023 tax exempt application, those should be kept permanently, those governance type documents. But then you also have the other financial documents, your bank statements, those types of things. Usually those are recommended. Best practices is to keep for 7 years. But it just depends. So really what this document retention and destruction policy is going to have in it is a list of your common documents that you have, and then how long you're going to keep them and how you're going to keep them. And you can keep them electronically or on paper. There's no requirement that you have to keep these documents on paper. And then also how and when you're going to get rid of them, shred them, destroy them. It also must include a statement that all destruction will be suspended immediately upon indication of official investigation or when a lawsuit is filed or appears imminent. And that's back to the whole Enron issue that happened. So making sure that if something were to happen, that we don't destroy our documents. If you don't have a document retention and destruction policy currently in place, I would highly recommend that you put one in place. And if you need a copy of one, we have templates that you can use that we would be happy to provide. That way you don't have to reinvent the wheel.
Hey, Carrie.
Yes.
Going back a slide, what would you consider to be the most important information to put in the minutes?
Oh, okay. So as far as minutes, we do not want to write down word for word what happened during our board meetings. We want to know the date of when it took place, who was there, and then also any significant decisions that were made. So the voting, so when you vote on different things, those kind of significant decisions. Also, remember too, if a quorum is not met, then you can't take any votes, can't make really any significant decisions. So you want to make sure you note that as well. So any significant decisions that were made, and then also, who was there, the date of the meeting are the main types of items that should be included in your minutes. And again, those should be written and maintained by the organization at the organization's office.
I would also add that if there's anything done via email in between the board minutes, that bringing that into the minutes is a best practice as well.
Right. Yes. Yeah. So if there was anything that was decided, voted on, via email, you might just kind of want to reconfirm that vote, or like Susan said, mention it in your minutes. So that way you have it documented for sure. Yes. All right. So next, things that we must do, other things that we must do. We must file a information return with the IRS. So unlike for-profit entities that file a tax return that show the revenue and income for the year, calculated tax, and then they pay that tax, we have to provide as a nonprofit a Form 990. And this, unlike a tax return that calculates tax, this is more of an informational return. So not only does it ask about your financial information, your revenues, your expenses, It also asks information about your organization's programs, its services, governance, your board. So there's a lot of information on a Form 990. Which form you file of the series depends on the type of your organization and also your annual gross receipts and assets. So if you are a smaller organization that normally receives less than $50,000 of gross receipts each year, you can file the 990N, which is the e-postcard. So this is a very short form. Basically, it asks for your organization's name, address, EIN, name of address principal officer, and then also checkbox, are your gross receipts normally $50,000 or less? So very short form, very easy. If your organization receives less than $200,000 of gross receipts, so you would be in between the $50,000 and the $200,000, but your total assets also have to be less than $500,000, you can file Form 990EZ. So this is the short form. You can also choose to file the full 990, but you can also file the 990EZ if you fall into this category. So this form requires information on exempt and other activities, finances, compliance with certain federal tax filings, and requirements and compensation paid to certain persons. There are also additional schedules required depending on the organization's activities. Then if your organization is larger and has over $200,000 of gross receipts or total assets of more than $500,000, you're required to file Form 990. And this is the return that asks for the most information. So in addition, again, to the finances, it's going to ask about board activities, compliance, legal requirements, and ethics. It consists of an 11-page core return. So just the main return is 11 pages, and then there are 16 potential schedules depending on the organization's activities. Now, there's not going to be an organization that needs to fill out all 16 of those schedules likely. Usually it's just 3 or 4 additional schedules, but the most common schedules are Schedule A that talks about the public charity or the public charities status. Schedule D that has some additional information on reconciling between your financial statements and your 990. Schedule G that talks about your fundraising, your special events, and then Schedule O, which is just kind of a extra form that has additional information on various questions. I will note that churches and certain church affiliated organizations do not have to file an IRS. However, all other organizations normally are required to file a 990 with the IRS. And again, if you are a small organization and want to file the full 990 form, you can certainly do so. I know some organizations actually that could file a small 990N or 990EZ choose to file the 990 just because of the additional information that it asks, and then they can provide that 990 to funders or to other people that are interested in the organization because it does provide additional information on that organization. So no matter which one of the forms that you have to file, it is due by the 15th day of the 5th month after the fiscal year. So if you're a December year end, it's due May 15th. If you're a June year end, it's due November 15th. If for some reason you are unable to get that 990 done by the due date, you can file an extension. You just need to make sure that you file the extension by that initial due date. If you do not file the 990, there are penalties. $20 a day up to $10,000 or 5% of gross receipts. That amount goes up if your gross receipts exceed $1 million. If you fail to file for 3 years in a row, you will automatically lose your tax exempt status. So it is very important that you file your 990 annually. If you do lose your if you're automatically revoked, you can be reinstated. However, you have to go back and fill out all the forms again and pay the fee. So it's very important that you continue to file those returns annually, because we really don't want to lose our tax exemption just because we didn't file a tax return. Just a few other filings that you might have to file depending on your activity. If you do have unrelated business income, then you're going to have to report that on Form 990T. Again, that's going to be the income that's not related to your exempt purpose for other activities, and you may have to end up paying some taxes on that. If you are an Indiana organization and you have a sales tax exemption where you are exempt from paying sales tax, you need to file the NP20 annually to make sure that you continue to receive that exemption from paying sales tax. In Indiana, you also have to file an Indiana Business Entity Report every 2 years with the Indiana Secretary of State. Basically, this is just letting them know that you're still in existence. There is a small fee also that goes along with that. If you receive money from the government, whether it in Indiana, you are required to file annually an entity annual report, an E1, with the State Board of Accounts. In Indiana, if the State Board of Accounts is responsible for determining whether organizations that receive government money need to have an audit done. So this report that is filed through the Indiana Gateway electronically, you have to report the revenue that you receive from different government sources, and then the state goes in to see if you need to have an audit done. So if you do get some government money, make sure that you are aware of that. Then also, if you spend more than $750,000 of federal government money, you have to fill out a form SF-FAC or the data collection form every year. That is after you have a special kind of audit done. So these last two items here, the E1 and the data collection form, just if you receive government money, just know that there's some additional reporting that you need to do. And then also, real quick on required filings, 403B plans. If your organization does have a 403B plan, you probably have to have a written plan document that includes specific details. And those are the plans that fall under ERISA. Also, plans with 100 or more participants are required to file Form 5500, the annual return report of employee benefit plans with the IRS. So again, if you have a 403B plan, just be aware that there are some certain requirements that need to be met every year related to that. Public disclosures. As a nonprofit organization, you've received a special tax exemption from the IRS, and in return, we have to make some things open for the public to see. Specifically, your Form 990 or your 990T if you have unrelated business income for 3 years after the due date. So your last 3 990s you have to make available for the public to see. You can put this on your website, or you can just have it available if someone comes to your organization and asks for it. Also, your Form 1023, which is your tax-exempt application. You need to make sure that is available. And then your IRS determination letter, where the IRS says, yes, congratulations, you are a 501c3 tax-exempt organization. That also needs to be made available for the public to see. Now, the IRS encourages your organization to make available your annual report, your financial statements, your conflict of interest policy, and other governing documents. However, they are not required to be made public. There is no law that says you have to make these items public. There are questions on your 990 as to whether you make these public. However, it is not a requirement. So if you would like to provide some additional transparency for your organization, you can certainly make those available. Charitable contribution substantiation. So when your organization receives donations from donors, If the amount is more than $250, it's actually the donor's responsibility to obtain some kind of documentation from your organization so that they can deduct that as a contribution on their 1040. However, best practices is that the nonprofit just makes that available. That way it's just easier for your donor. When you do make that document available, make sure that it does include certain information, the nonprofit's name, EIN, date of contribution, and the amount of cash that was given to the organization. If they provided you in-kind property, if they provided you supplies or books or something like that, you do not, as a nonprofit organization, do not put a value on that in this document. You just provide a description as to what was given. It is their responsibility to get that dollar amount for their deduction on their tax return. Oh, and then also on that document, you also need to note whether any goods or services were provided in return for their contribution. And if none were provided, you need to specifically say that no goods or services were provided in return. However, if there were goods or services that were provided in return, for example, the annual fundraiser event where you buy a ticket for $100 and I get to come to your fundraiser and in return I get a meal, then that's called a quid pro quo contribution. So part of my $100 is a contribution and part of it is to cover my meal. In that instance, the nonprofit is responsible for providing documentation to the donor saying, thank you for your ticket of $100, X dollars is a contribution and X dollars is non-deductible. And again, there is a question on Form 990, whether you provide this to your donors. So you want to make sure that you follow that rule. And then finally, the last item that we want to just make sure that we do, public charity status. When we first apply to be a nonprofit, 501c3 organizations are either considered private foundations or public charities. All of you, or most of you probably joining us today, are public charities. Private foundations are subject to other rules and regulations as well as excise taxes. So for example, like Bollinger Foundation is a private foundation. Most of their, or all of their money came from one family, and then they are required to give out so much money per year. They also are required to pay excise taxes on certain activities. Public charities are not. So each year when you file your 990 with the IRS, there's a schedule called Schedule A that looks at your organization's activities for the current year and the previous 4 years to determine where you're getting your money from. And then that determines whether you whether you continue to be considered a public charity or a private foundation. As a public charity, you really want to make sure that you continue to be a public charity and get your revenue from a wide variety of sources. Because if you don't, then you will fall back to be a private foundation and again have those additional rules and regulations that public charities do not have. So that is all of the items that we had to talk today about the do's and don'ts of being a tax-exempt organization. So thank you for joining us. I think Amanda's just going to talk briefly about our upcoming webinars and other education areas that you can access through DWD.
Real quick
thank
before
you.
you get started, Amanda. We have a question that they want to know if Carrie's audio will be available with the slides.
Yes. And what we're actually going to do, this session was recorded. So if you give us, hopefully before the end of the day, the slides as well as the recording should be posted on our DWD website in the nonprofit education section. We'll actually go ahead and send out an email linking to those two areas. And then also on that same nonprofit education page, that's where we add our upcoming webinars. So the next one you can go ahead and register for will be in September, on September 14th, board review of Form 990. So this will be a great session for you to also share with your board members, specifically those new to serving on your board. Thank you guys all so much for your interest today. And then when you go ahead and log out, a short survey should appear. So we would appreciate any feedback you could give us. Thank you so much and have a great rest of your day.